Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Castor Maritime stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Castor Maritime transports dry bulk cargo, crude oil, and refined petroleum products by vessel across the ocean. During the 3 months ended September 30th, 2021, it operated on average 24.3 vessels, earning a daily time charter equivalent rate of $16,913. That's compared to an average of 3.6 vessels earning a daily TCE rate of $7,273 during the same period in 2020. The company has grown by leaps and bounds. They're operating more vessels because they purchased so many, and their rates have gone up so much. During the third quarter of 2021, the company received 4 vessels consisting of 1 Kamsarmax and 3 Panamax dry bulk carriers. With these 4 vessels, its fleet is up to 27, with an aggregate capacity of 2.3 million deadweight tons. Its fleet size has quadrupled since December 2020. Earlier in the year, the stock price was below $1, so in order to continue trading on the Nasdaq, the stock has to be at least $1 a share. So they did a 1-for-10 reverse stock split in May of this year. The number of ships in the market is highly correlated to the profitability of shipping companies. The cost to maintain the ships is fairly fixed, depending on the age of the ship. The revenue each ship receives can vary a lot depending on the number of ships available in the entire market. There will always be demand by companies looking to transport raw materials or oil. On average, after 21 years, a ship gets scrapped. The goal when investing in a company like this is to try to figure out when the total vessels in the market is low. That means shipping companies will be able to charge more per voyage. When there are too many ships in the market, then rates come down a lot and the shipping companies lose money. Castor's fleet size is 13.4 years, which is higher than the average vessel in the market. Older vessels are usually less fuel efficient and more costly to maintain. Cargo insurance also increases with the age of the vessel. As vessels age, market conditions might not justify the added expenses, so scrapping the ship may be the best option. The bad news is steel prices have decreased about 30% in the past 6 weeks. When steel prices come down, then purchasing new ships is a smart move. 18 of the company's 27 ships transport dry bulk cargo. A way to gauge the profitability of this company is to track the Baltic Dry Index. This is an index of average prices paid for the transport of dry bulk materials across more than 20 routes. To put it simply, this index reflects the supply and demand for this industry. In 2007 and 2008, dry bulk shippers were making money hand over fist. The bad news for this company is the Baltic Dry Index has decreased 50% over the last 2 months. The good news is the rates are still higher than they were any time between 2010 and 2020. The company is headquartered in Cyprus and was founded in 2010. It started trading in 2019 and can be found on the Nasdaq, Norway OTC, and Deutsche Börse. Let's get started with the model. This is a micro-cap company, 189 million market cap. They're trading at $2 a share, and they have 95 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow every year, except 2018, it was really small. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that looks really good in trailing 12 months. Revenue is the sales for the company, and that went up 19 times from 4 million up to 76 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's grown a lot from 1.6 million up to 32 million. Below that is their operating expenses, then their operating income, which also grew quite a bit from 1 million to 24 million. Below that is the interest they pay on their debt. That was $500,000 in the trailing 12 months. And the bottom line of the income statement is their net income, which was their highest ever in the trailing 12 months at 22 million, negative in 2020. This is their income statement from their third quarter reporting. And this shows us the first 9 months of 2020 versus the first 9 months of 2021. Look at the improvement. Their revenue went from 8 million up to 72 million. They're doing an amazing job at growing their revenue, and it's all organic. Below that is their voyage expenses, and that was 7.2 million in 2021. This is mainly brokerage commissions, port expenses, and the fuel for the vessel. Their biggest expense is vessel operating expenses, and that's the cost for the crew, the docking cost, the insurance, repairs, and maintenance. It's really expensive to dock these vessels because they're so big. You have to find a place to put them between voyages. They had 2 million from G&A expenses. These are expenses from legal, investor relations, and their directors. They paid $132,000 to have their stock listed on the Nasdaq and Norwegian OTC market. Listing your stock in different exchanges does help with liquidity, but it's also more expensive. 4.6 million in management fees and 8.8 million in depreciation and amortization. Look how much they're improving. In the first 9 months of 2020, they had a net loss of 1 million. In the first 9 months of 2021, a net gain of 23 million. It's like day and night between their 2020 financials and 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. And they spent a lot in CapEx in the trailing 12 months, 338 million, because they were buying a lot of new ships and vessels. Operating cash flow minus CapEx gives you your free cash flow, and that was negative every year except in 2018. But having negative free cash flow due to a large CapEx expense, because the idea is these vessels will generate lots of revenue and lots of cash flow. They were able to get most of the money to buy these vessels by diluting the shareholders. They raised 274 million by issuing stock. When a company issues stock, it increases the shares outstanding, making your shares less valuable. Issuing stock and taking on debt isn't always a bad thing. As long as your return on your investment is greater than the amount you diluted to shareholders, then it's fine. But if the vessels don't make much money for the company, then it was a bad use of capital. They also added 24 million of debt in 2019. This is their cash flow from operations section from the first 9 months of 2020 versus the first 9 months of 2021. So to calculate cash flow from operations, we start with net income, that's 23 million. Then we have to add or subtract the non-cash items from the income statement. This company passes through lots of depreciation expenses because they're sitting on so many fixed assets, all their vessels. They had 8.8 million of depreciation. We have to add that back. That's a non-cash item that brings down your net income. And we also have to adjust for changes in working capital. It looks like their customers owe them $3.8 million, and they bought 3.4 million of inventory. That's a cash outflow. And they have 4 million of deferred revenue. This means their customer paid them in advance. So maybe the voyage was 6 months, and the customer paid for all 6 months up front. But they can't book the revenue until the voyage is complete. So even though they reported a $23 million profit, they actually generated over $28 million of cash flow. In the cash flow from investing section, they spent $309 million in acquiring vessels. So they had a cash outflow of $312 million in their investing section. In their financing section, they received $265 million from issuing more stock. They took on $74 million of debt. They paid $8.5 million of debt. So in their financing section, they received $317 million of cash flow. This is the equity section of their balance sheet. They have $328 million of equity. They raised $306 million from selling their business, and they profited $22 million from running their business. So this looks really good. Let's look at the capital structure. They have 328 million of equity, 82 million of debt. They're 80% equity, 20% debt. And I gave them the lowest whack on Finbox of 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that 793 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $433 million. We divide that by 95 million shares. And we get a calculated stock price of $4.58. They're trading at $2, so they're trading at a 56% discount. It's a strong buy according to the model. Now that the company has a much larger fleet, I think their revenue will start growing a lot. So I grew at 50% each year for the next 4 years. And it looks like they're going to have negative free cash flow in 2021. And I think they should be able to convert 15% of their revenue into free cash flow after that. The reason they had such a big negative free cash flow in the trailing 12 months is because they bought so many vessels. But going forward, those vessels should be able to generate the company lots of revenue. This is from the company's latest news release. This talks about 4 of their upcoming voyages. A 2010 Panamax is going to go on a voyage between 11 and 14 months. And the rate it's going to receive is 92% of the Baltic Dry Index. You can see how dependent this company is on these rates. When the Baltic Dry Index peaks, the company makes a ton of money. When it gets really low, the company doesn't make nearly that much money. The index has dropped quite a bit, but it's still higher than it was the past 10 years. As I was alluding to earlier, the index is based off of supply and demand of the market. When there's so many ships out there, then these prices go down because there's so much supply. When more of these ships get scrapped or some of the shipping companies go bankrupt, then the index will go up because supply will go down. So we don't know the exact dollar amount they're going to receive. We just know it's 92% of the index. Another voyage is 101% of the index. That's going to be between 11 and 14 months. The third voyage is for only 45 days, but they're getting a premium, $19,000 per day, plus a bonus of $550,000. And the rate for the last voyage is 91% of the index, and that's going to be between 11 and 14 months. So it's pretty easy to figure out when this company will be profitable and when the stock price will go up when rates are high. But the hard part is figuring out when rates will climb back up or when they will drop. This is where the stock has been trading in the past year. It peaked in the beginning of 2021 when rates were really high. But when rates came down, so did the stock price, and the stock price got to below $1. It was never this high, $17. They did a 1-for-10 reverse stock split around here. They listed the S right here where the stock split occurred. It appears this peaked at close to $20. You have to divide that by 10. It was actually trading at $2 that day. And when you see $5 right here, it was actually trading at 50 cents. Anything before this S, you have to divide by 10. A company does a reverse stock split so it doesn't get delisted. That's usually a bad sign when a company does a reverse stock split. But shipping is such a cyclical industry, unfortunately they have to resort to these measures to stay a viable company. And when these companies lose money, it's not because they're running a bad business. They're forced to charge what the rates are in the market. It's kind of like a commodity. You have to charge the market rates. If you mine silver or gold, you have to charge the rates in the market. If you're a designer and you take that gold or silver or diamonds and make that into a really nice ring or necklace, then you could charge a premium because it's different. But for the raw material, you have to charge the market rates, or the customer would just go somewhere else. They have a low beta, 0.44, so the stock doesn't move too much. It moves half the market. It's gone up 23% in the past 52 weeks, while the S&P is up 31%. The 52-week low was $1.40. The high was $19.50. All these numbers are split adjusted. Obviously, the stock fell below $1. That's why they did a reverse stock split. And the stock is trading below its 50-day and 200-day moving average. About 3 million shares are traded each day on this stock. Pretty much all the shares outstanding are on float. 4% are held by institutions and 4% of the shares are shorted. If you invested $10,000 into this company when it started trading, you'd be at $400 today. That's what happens when you do a reverse stock split. It really dilutes your shares. So you can see this company and this industry has really struggled. So if you buy it now, you may be buying it at a major discount and there could be amazing upside, 10, 20, 30x. But you really have to time it right. Because if you buy at the peak or close to the peak of shipping prices, then you may lose most of your investment. But if you buy at the low point when shipping rates are low, you have some huge upside potential. The biggest shareholder owns 1.4% of the stock, then Renaissance Technologies, Citadel, Morgan Stanley, and Savvy Management. They have really good price multiples, a PE of 8.5, that's just amazing. PE, a stock price over earnings per share. Price to sales of 2.5, which is really good. Look at that price to book, 0.6. Because they have so much fixed assets on their balance sheet, those vessels are really expensive. And they're worth more than a company's market cap. So it's almost like taking no risk when investing in this company. Because if you liquidated the assets, you would get more than $2 per share. You would get $3.47. They have a pretty low ROIC, only 5.2%. They can easily cover their interest payments 44 times. They have a decent ROE at 7%. They have a pretty high current ratio and quick ratio. And they have a pretty solid balance sheet, $36 million of cash, $2.4 million of restricted cash. Restricted cash is cash that's set aside for a specific purpose. So they do appear to be undercapitalized. They had negative $312 million of free cash flow, but that was in the past. I don't think they're going to be buying as many vessels going forward, so their free cash flow should be positive. And they have $23 million of working capital. Working capital is current assets minus current liabilities. So I think they should be well capitalized going forward, assuming they don't buy a ton of vessels like they did the past 9 months. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 3 other companies in the same industry as Castor. And if Castor has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. Their PE is actually worse than the average, but 2 of the companies in this industry have negative PEs because they have negative earnings. Synergy has a really good PE at 6.5, which is a little better than Castor, but both have amazing price earnings ratios. Castor has the worst price to sales of these 4 companies, but Castor has the best price to book, so they have the best balance sheet. Castor is doing well in current ratio. The average ROE is negative since 2 companies have negative earnings. Castor has the lowest amount of debt of all these companies, which is pretty impressive with all the vessels they've acquired the past few months. And CTRM is about average in market cap. These are really small companies. They don't even total 1 billion market cap, all 4 combined. And only one of the companies pays a dividend. Tops and Nordic mainly ship oil. Synergy is mainly dry bulk. Castor does both, but it's about 2/3 dry bulk and 1/3 oil. So a good comparison is Synergy with Castor Maritime. Castor's ships are older, 2 years older on average. Synergy has less ships, but they could carry more on them because those ships are bigger. To summarize, I have them trading at a 56% discount. So it looks like this stock has really gotten beaten up. But like I said earlier, you really have to time it right. And you don't have to time it perfectly. But if you see shipping rates are getting to an all-time low or getting close to an all-time low, then there's so much more upside potential. But if shipping rates get to an all-time high or close to an all-time high, there may not be that much upside potential. I like to invest in a stock and not think about it. Just let it sit there for years and years and years. You don't really want to do that with this stock. You have to track it a little closer. But given everything I said, I do think this company has great potential because the products they ship are so needed in the world. As we get greener, the commodities they ship are so valuable. Plus they ship oil, which we know every country needs. So the demand for their service is never going to go away. I rank their free cash flows 1 out of 10, their revenue 6 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.